Have you heard of the company Deckers? I haven't been in the US in a long time, and so I haven't heard of it. But Deckers is driving profitability in a crowded market. While Nike and other giants lead the footwear market, there's another brand that's catching up. Deckers is securing unique and powerful position in the highly competitive footwear market. Deckers' profit margin is nearly double that of Nike. Can you believe that? That's incredible. So let's take a look at how Deckers is achieving these exceptional margins and growth. Welcome to this Valuation Masterclass case study. My name is Andrew Stotson. For over 30 years, I've helped thousands of finance professionals master company valuation in months, not years. And in this video, you're going to discover how Deckers drives success by leveraging its robust brand portfolio. And we're going to analyze the effectiveness of Deckers' competitive advantage and then evaluate Deckers' potential using my global stock tracker. So remember, you can click the link in the description to get this presentation and my global stock tracker of the top 500 companies for free. In fact, I update it every Monday and send it to you. Deckers is a leading player in the global footwear industry, competing alongside giants. Of course, the biggest is Nike, then Adidas, then Puma, then Skechers, then Under Armour, and then Deckers. So Deckers Outdoor Corporation is an American footwear and apparel company. Its products include footwear, apparel, and accessories for various activities like outdoor adventures, casual wear, and performance sports. While Nike and Adidas focus on sportswear, Deckers emphasizes lifestyle and performance footwear, targeting a broader target market. Deckers' portfolio includes globally recognized brands as UGG, Hoka, and Teva, as well as Sanuk. But 40% of their revenue comes from the Hoka brand, a favorite among runners. I remember seeing this the first time and seeing people running them. I was kind of like, wow, it's like they're running on a huge cushion. In fact, these Hokas are the lightweight and have maximum cushioning, making them popular among long distance runners. Now, 45% of their revenue comes from the UGG brand, known for casual luxury, blending style with functionality. And then the remaining 8% comes from Teva and Sanuk and other brands. Now, here's a fun fact. The word Sanuk means fun in Thai. We say Sanuk. The brand was named Sanuk because Deckers wanted the name to reflect the playful, laid-back, and enjoyable lifestyle that the footwear embodies. Now, North America is Deckers' largest market for sure, and they're getting about 65% of revenue there, with 20% coming from the Middle East and Europe. And what's the company's competitive strategy? Well, let's see. First, the company has 4,200 employees, and its competitive advantage comes through strong brand equity, premium pricing, and a diversified product portfolio across multiple footwear segments. It's a different strategy than what we see, let's say, Nike or the others. And it's achieved this competitive advantage by investing in brand control, limited distribution strategies, continuous product innovation, premium material use, and successful marketing campaigns. So let's discover how Deckers drives success by leveraging its robust brand portfolio. Deckers has built strong brand portfolio, each targeting different consumer needs. We've got fashion lifestyle in UGG and performance lifestyle in Hoka as an example. So each brand has a unique, distinct positioning, reducing dependency on a single product category. Rather than competing head-to-head with giants like Nike or Adidas in mass market sportswear, Deckers is dominating specific high-growth niches like sheepskin footwear. Hoka is one of the fastest growing running shoe brands focused on comfort and performance. That's a niche. And Teva leads the outdoor sandal market, a category that many competitors overlook. Now, by controlling distribution, Deckers ensures brand exclusivity and premium positioning and pricing. Deckers prioritizes premium retail partners to align with its brand positioning. Revenue largely comes from its own stores and websites, ensuring control over pricing and customer experience. And the company restricts distribution in specific markets to prevent overexposure and ensure brand value is preserved. The premium nature of UGG allows for significant markup as customers value the brand. You can see how beautiful the displays look. And Deckers boosts brand identity and demand through storytelling and influencers. Now, the result of this is incredible. Deckers shows resilient financial performance with a high average gross profit margin of 50%. In fact, in 2024, it was 56%. Remember, the average profit margin of a typical company around the world is about 30%. So it's incredible. The operating profit margin is about 22%. That's about double the global average, and 19% for net margin, which is about 3 times the global average. So incredible profitability in this company. So what's the company's competitive strategy? Deckers' success lies in its diversified portfolio of premium brands and innovation. The proof is its sustained 50% gross profit margin, which is hard to argue. But does this lead to a competitive advantage? I use my world-class benchmarking scorecard to measure if a company has a competitive advantage. I developed this scorecard 10 years ago, and here's how we construct it. My team gathers the yearly and quarterly financial data of 26,000 companies worldwide. We then calculate each company's profitable growth score, which is a composite measure of both profitability and growth. And after that, we rank the company relative to sector peers of a similar size. So a decile ranking that we're looking at is a 1 or 2, which is financially world-class. And we assess the company's performance over the prior 4 years and the past 12 months. So is Deckers financially world-class? The answer is absolutely yes. They are ranked in the top decile, number 1, from 2021, where I have the data, till the past 12 months. So for basically 5 years, when compared against 920 large consumer discretionary companies worldwide. That is incredibly impressive performance. Now, revenue growth CAGR from 2016 to 2024 is about 11%, which is 5 percentage points higher than the global sector average. So they're growing at the top line. In fact, the last 3 years have been growing between 15 and 24%. And Deckers outperformed during COVID due to a rise in demand for comfortable footwear, when in fact, in 2021, the overall industry, the consumer discretionary industry, went down. Earnings went down by about 7%, but Deckers' revenue went up by 19%. So does its strategy lead to a competitive advantage? The answer is yes. Deckers has shown consistent profitable growth according to our scorecard. So what does the valuation look like? Well, the stock price has been on a strong upward trend since 2023. In fact, it's gone from about $25 up to about $200 from 2019 all the way up till today. Now, let's evaluate Deckers' potential using my global stock tracker. So first, let's look at the F in FVMR, and that's fundamentals. So it has above average profit margin of about 19% versus about 16% for the industry average. So this industry group is basically very profitable. And Deckers' net profit margin was significantly higher than Nike's and Adidas. Nike used to be much higher, but now it's only at 10 for net profit margin, and Adidas is at 6, whereas Deckers is at that 19%. And ROA is significantly higher than the industry, reflecting efficient asset utilization. So basically, the ROA, the return on assets of this company, is 28%. That's just incredible when you consider that the industry is at about 12%. So next, let's look at in FVMR, let's look at the V, which stands for valuation. Is it cheap? Is it expensive? Well, it's got a higher PE ratio of 35 times for the company relative to 33 times for the industry. So on a relative basis, we can say that the company is slightly more expensive, but the profitability is incredibly much higher. So on a relative basis, I think you could say that there's still room to go on that PE. Now, on a price to book value basis, because the returns are so high, the company's trading on about 15 times price to book. That is extremely high. I would be very careful at that point. The industry is at 7.6. So on a PE basis, I would say I'm not too worried, but at a price to book value basis, it seems a bit expensive. Now that also, we have to look at, what's the structure of the balance sheet. So what you can see when we look at momentum is the following. The 3-month EPS momentum is 47% versus only 15% for the industry group. Incredibly strong performance right now. And EPS growth has been consistently higher than the global sector average. In fact, in the first quarter of 2025, revenue was up by 22%, driven by Hoka and UGG growth. Net income was up 82%, and EPS, of course, 87%, which was an excess of analyst expectation. Free cash flow was up over 100%, and the CEO emphasized the direct-to-consumer and international market expansion that they're doing. So there's been strong stock price momentum, which is reflecting, consumer confidence in this company. The stock price is up about 34% quarter on quarter versus about 14% for the industry group. Makes sense. The company is really knocking it out of the park right now. So now let's look at risk to understand the balance sheet. So there's about 1.2 billion in cash and about 259 million in debt. And that means there's only 7% of assets that are financed by debt, which is a very small amount. In other words, the company doesn't really have much debt. In fact, the net debt to equity is minus 0.5 versus the industry's positive 0.3. Negative net debt to equity basically means it's a net cash company. So debt's not a big worry. And there's a higher beta, which suggests more volatility. And we can see that the beta of the company is about 1.4 times versus about 0.5 for the industry group. So it definitely is higher beta. So overall, from a valuation perspective, I would say it looks interesting on a PE basis. On a price to book basis, it looks a bit expensive. But if momentum can keep up, well, at these levels of margins and these levels of growth, it's producing a huge return on invested capital, which may make it a good investment at this point. Now, remember to click the link in the description to get this presentation and my global stock tracker of the top 500 companies for free. In fact, I deliver that every single Monday morning. So Deckers is driving profitability in a crowded market. I'm curious what you think about Deckers valuation and performance. Please leave some comments to let me know.